Good afternoon, everybody. We're going to try this one again, my special report on the S&P 500 now that I've got my microphone fixed. I'm Dan Hussey from Zaner Financial Services, bringing you a special report here on August 11th, 2022. Going to be going over some longer-term time frame charts of the S&P 500, monthly chart to be specific here, to show you some analogs going back and looking at past recessions, where they've been, periods of inflation and price expansion that have occurred thereafter, and how we're very, the pattern of trading very large ranges, breaking out of those ranges, trading to 10 times multiples and big volatile moves is nothing new. It's just a matter of scale in the stock market. So let's begin with this monthly chart that I have in front of us of the S&P 500, basically from the post-Great Depression there in the late 30s, going into the World War II era. And then starting in 1945 here, well, actually it was 1946, when the 55-month moving average, which is this orangish-brown line, crossed back over the 200-month moving average. And ever since that bullish crossover, those two indicators have never had a bearish or death cross thereafter. We've come close two times in history, in 2012 and in 1978. There you can see on the right side of this chart, it came very close, but never happened. And so the first recession that I'm calling to our attention is a price move that occurred from, if you measure from zero to all-time highs at the time of 120, we pulled back into the $60 area. So that $60 or 50% decline during that period over that 8 to 5 year period of sideways price action for the S&P was a daunting time for the market. Certainly the recession that occurred in the 70s post the housing and savings and loans collapse was a financial crisis that resulted in the implementation and creation of Freddie and Fannie Mac and some of the other institutions that we've seen kind of fall to the wayside as I think major players in at least in our financial markets, but they certainly, the bailouts that occurred at the time and the saving of the savings and loans was a housing recession that for the previous generations has occurred yet again here into the 2000s in that financial collapse we saw in 2008. Anyway, this would be a sideways or flat structure, corrective structure, if you're a student of Elliott wave, where the market went from an all-time high down to a low, to a new all-time high, and then back through that prior low. That three-wave correction resolved itself with the lows of around $60 per contract, and the following decade that occurred out of that period resulted in the market continuing on to new all-time highs. It wasn't until the market topped out around 340, where then we had the next big recession, or there were certainly minor pullbacks here, but the recession of the late 80s and the period of inflation that occurred then, while it was very different from in terms of interest rates, where we were actually at all-time highs of interest rates, and then from that point on we've only seen a declining interest rate through about 2012 in the US. The market did fall from a high of around 340 down to lows around 220. This decline, or the original Black Monday decline, was 50% pullback from extended pullback drawn from the highs, the prior all-time highs to new highs around 229. In 1978, as I mentioned, that 50-month moving average and 200-month moving average almost crossed over, but it didn't, and the market stayed above both those figures, and the market was allowed to increase by price expansion of about threefold. That's very similar to the price expansion and price action that we've seen coming out of the dual recessions from the tech collapse in the early 2000s and the financial housing collapse that we saw in the late 2008 era. We also made an expanding flat correction at that time from all-time highs of about 1,500, very reminiscent of the 120 high, made a new low, made a low around 75 or 750, excuse me, went to new all-time highs before then falling back down to a new low of around 670, 666 in the futures. That new low that we formed from there certainly dragged the 55-month moving average to an almost bearish crossover with the 200-month moving average. But the period over the next 10 years has been met with a rally to new all-time highs of to the pre-pandemic recession, or the millennial Black Monday that I like to call it, that occurred in March of 2020, lows that occurred around 2020, off of a high of around 330. So that 3,030, excuse me. So many similar numbers here. It's easy to get confused. The highs of 330 correlating to our highs pre-pandemic recession of around 3,300 were met with that 1,100 point decline, very similar to the 110 point decline down to the lows of 220 we had on Black Monday. After that Black Monday low, the market rallied to a new all-time high over the next couple years. It took about 3 years to get to a new high of around 360. Now, we didn't get as high as we got here this go around. We went to highs around 4,800. But the idea that we've more than doubled, or almost doubled, the valuation of the stock market from its lows to highs at that time is what's important here. And this blue circle on the chart is very similar in terms of the pullback that I believe we just saw, and are in the midst of, in the current recession that we're seeing after the Black Monday type move that we saw. From the Black Monday lows of 216 to the new highs thereafter of around 370, we had a 50% retracement down to 298. And then from that low, the market began a period of price expansion and inflation that lasted all the way to the 2000 tech highs. The 90s were the biggest period of price expansion, the biggest period of economic growth that we've ever seen in human history. And we very well might be heading into a very similar time period. And it's very easy to get lost in the day-to-day news and take our eyes off of what is otherwise a much larger move playing out in inflationary move playing out in the financial markets. So again, we rallied up to a 4,800 high. We pulled back. We didn't quite get to the 50% retracement at 3,500. We can't rule out a move down to 3,500 to 3,400 yet at this time, but the market has pulled back from its all-time high a couple years after that, shortly after making a new all-time high, but a couple years after that Black Monday low. This, of course, I'm referring to the what I refer to as the millennial Black Mondays, which occurred in March of 2020 with the COVID pandemic. Both Black Monday sell-offs were what could be construed as false financial crises. They were man-made. Back in the 80s, it was fears of financial collapse in the bond markets and things that never really came to fruition. And with the advent of COVID, we really had a man-made recession that, for all intents and purposes, should never have really happened when we look at where we are looking back now over the last couple of years. Needless to say, the market did see a substantial pullback. It lost significant value and is holding at or near levels that correlate with the pullback that we saw following that Black Monday low in the 80s, the rally that happened in the early 90s, and giving us that one final pullback here into the start of that new decade. I would attribute this to being a very similar type pullback, and the question now is, is the low that we have enough to establish the next period of price expansion and inflation? Because if it follows suit and the market rallies from around 300 to 400 to 1,600 in that era, it would mean that the market would be rallying from 4,800, 3,000 to 4,800 to 10,000 or 12,000 for the S&P 500, and fully encompassing a 10 times multiple expansion over a 30-year period that we've seen happen before. So it seems like every 30-year cycle in the S&P that we're looking at expands by that 10 times multiple. And that's, this is some of the price action of how we could potentially get there. Now let's take a look at the S&P 500 on a smaller time frame right now, though, because there's certainly more to look at going down to, the 4-hour chart. We're in a pretty good trend channel higher, and we are now up into the full 50% retracement from the 4,800 highs down to the 3,600 lows. So it's going to be very important for the bulls to be able to push this market back up to 4,400, break the trend line against the highs, put pressure on the 6-2-8 line of this decline, which would then start to bring up the notion that the bulls are starting to make more progress off their low than the bears are able to, kind of keep down. There's, of course, a lot of moving parts here going on in global, geopolitical dynamics. We have the U.S. hiking interest rates at a rate that we haven't seen in decades. That is certainly something that could put a damper on some of these rallies. But we also are seeing a period where the U.S. dollar is starting to decline, which could signal, from the Fed with, price, price inflation in commodities starting to be quelled, could signal a time in the Fed for more easing rather than future, a string of future interest rate hikes, which would be very bullish for this market at this time. For all intents and purposes, the Fed may have backed themselves into a corner now, having had to play catch up with inflation, doing some unprecedentedly large rate hikes for the current market we're in. And they might be, certainly might be encouraging, unfortunately, an economic recession, not necessarily one in price on the S&P, but it could result in, more pressure on this market. And of course, the market heading down towards that 3,500 level. I know I will certainly be ready to get my 401k and other things back to work for me if we see those levels, trade again, based off the analog I'm looking at from the past. So can't rule out one more move and certainly a sell-off for, below 3,500 at this time. And I would expect it to begin somewhere between this 42 to 4,400 area. But, the longer-term charts and the larger-term monthly and certainly 30-year patterns that the stock market suggests at this time mean that the market could be starting its to travel higher and could be entering into a period of price expansion that could take us to the 10,000 to 12,000 mark here by the end of this decade. With all that being said, we'll see how things play out. Like I said, there's a lot of moving parts, but I figured it was a good time good time as any. Every year I look at these charts a couple times to try to bring people up to speed with what I see on the bigger time frame. And that's what we've got going on now. If you ever want to get in touch with me over here at Zaner, give me a call at 312-277-0110. You can find me on Twitter and Facebook or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we'll be back with you as more price action develops.